Hello, welcome to another Winalyze webinar from the series Insurance is all about data. When we talk about data in insurance, we have to talk about underwriting. And as we talk about technology, we also have to talk about digital underwriting. So today, the topic we've chosen is how to implement a successful digital underwriting strategy. And we have today, who I believe, one of the best speakers from the industry about this topic, Taffy. How are you?
I'm good, thank you. How are you?
Good, and thank you for joining us. I think this is a very relevant topic. I think a lot of people from our natural audience will be interested. Data, underwriting, and digital are three very big keywords in insurance and the insurtech space. So to start with, Taffy, what's your background and how did you end up in the digital underwriting space?
Yeah, that's a great question. So I purposely ended up in insurance. I actually studied insurance and risk management at university. And from the moment I entered the industry, we were at a point of transition. So it was during the early days of computers on underwriters' desk and the .com era. And as a young person in the industry, I was given the opportunity to think about how we might transform our underwriting strategies. So it's sort of been something I've been doing off the side of my desk for the balance of my career. About 5 years ago, I took a transitional role to lead an underwriting transformation, digital and technology and data enablement strategy for a major global insurer, and it became a real passion of mine.
Good. And so we can see that underwriting has been different or has been changing, especially during the last few years. I guess my question is, what's the difference between digital underwriting and non-digital underwriting? Is there such a thing?
Well, I think, first and foremost, it's important to understand the demands of the underwriter have changed. Underwriters used to be given the responsibility of being technical experts with respect to analyzing risk, but also really knowing the coverage forms inside and out. And as the world has moved on and data and information has become readily available, underwriters have really had to embrace some of the behaviors, disciplines, and competencies of data scientists. So the role of the underwriter has changed. The expectation of the underwriter to do more than underwrite a single transaction has also changed. And so with that, the need for digital transformation, data, and for sort of that data strategy and technology enablement has also increased.
Yeah. And if we think about this transformation process, what's the first thing to do to transform underwriting into a digital process? And more or less, what are the benefits that we will see if we do so?
Yeah, so I think first and foremost, it's about improving the underwriting decisions, right? It's also, efficiencies will come from the digitization, the datification of the commercial insurance world, similar to that of personal lines. But first and foremost, there's a culture, a talent, and a data strategy that has to be undertaken. So in terms of, getting it right, the first thing I would argue is understanding what your data sources are, what data is truly needed, what data is no longer needed and not relevant, and then coming up with a data governance strategy. So the idea is once you do that, you can begin to change and transform the expectation, the role of the underwriter, where the underwriter now interacts with data that's been liberated and produced in a format that is easily consumable and digestible for underwriting decisions. So you take away the mundane and you put those decisions in front of the underwriter that needs that human intervention. Again, the other part of that is going to be your talent strategy and transitioning, right? So you can't hire talent for tomorrow and focus on yesterday's task. So you need to transition today's talent, focusing on tomorrow's task, and then hire tomorrow's talent for the task of tomorrow. So it's and that really means that you're asking for underwriters to partner with data and the technology in much of the ways they're currently interacting with and partnering with their human colleagues.
Mhm. And I think when we talk about this sort of transformation, I think transformation along with innovation, sometimes in the insurance industry are both scary words. People don't want to talk about changing anything, let's say, but then some other people do. So I think we can see like a lot of differences between departments, teams, and even insurers themselves. So I think what we've seen is that the cultural aspect or the cultural approach of these corporations is very relevant and is probably the key to embrace this transformation. When you work with insurers or when you undertake this kind of transformation processes, how do you know if a corporate is culturally ready to do that?
Yeah, that's a great question. And what I would say is when I was on the carrier side, we brought underwriters from various generations together, from front office underwriters to back office underwriters. We brought some operations folks together with claims folks, with pricing actuaries and reserving actuaries. And you saw the various sort of acceptance across the continuum for moving towards a transformation strategy. Underwriting underwriters are obviously risk aware. They're also notoriously risk averse. And so much the way insurance carriers are. And so you see a lot of insurance carriers who are hesitant to be the first mover, and you'll see others be the fast follower. So one of the things is to really look at where have they come with their data strategy. How are they thinking about data? Have they embarked upon creating the right sort of data strategy, a data lake? Have they understood how data is used and across the various functions? And have they created a data environment where everyone is looking at the same data, but to solve for their different areas of opportunity? The other part of that is looking at their talent strategy, understanding what they have done with their talent and the overall sort of, I would say, attitude of the organization towards risk, right? So as we, sort of think about the world we live in, the velocity of change has never been as swift as it is now, and it continues to increase. And so in that way, you see the industry needing new tools and techniques to extract the immense value embedded in the data that we've already collected, but also in thinking about what are the new sources of data, and have I validated, tested that data, and am I trusting of that data? Or do I have an underwriting team, an actuarial team, a claims team that is insistent upon using old means and methodologies for collecting data and analyzing the data?
Yeah, I find that approach very interesting. So basically, you say that one thing to look at is what's the talent that we have, and the other thing is what are the data strategies that we have. And if we assess both things, we will be able to understand if they are ready to embrace, let's say, the cultural challenge that transforming underwriting means. That's very interesting. One thing that one topic that we have when we talk to insurers and we talk about using external data for their daily tasks is that they are concerned about the frictions that might cause, especially the friction with the broker, because in the end, the broker is collecting data and is sending it back to the insurance company and to the underwriters. And external data sources might have discrepancies with the data the broker is sending. So I think carriers are afraid of correcting brokers' data when this data is wrong. And we've been trying to see how do we solve this challenge. So do you have any tip or any thought on how do we solve the friction between underwriters and brokers when we use new data?
Yeah, so it's an interesting question. And when I was on the carrier side, I was always stunned at the way the data came in from the brokers. And it did seem as if there was friction purposely embedded into the industry. Now that I am outside of the carrier world and sort of straddling adjacent to consulting and broking, one of the things that I understand more and have an appreciation for is that first and foremost, the insured is not in the insurance business. They're in the business of what they do to serve their industry and their clients. They understand financial information. They understand the information that's important to their industry. We often ask for information in a way that they don't understand. Business interruption and business income worksheets are a perfect example. It's insurance finance versus sort of rest of world finance. And so the brokers have the immense, responsibility for not only producing a risk management, risk transfer, insurance strategy that is optimized to the insured's benefit, but they also have to educate their buyer, our mutual buyer, with the insurance terms and those sorts of things. So ultimately, they're collecting the data from the insured who's giving us the data the best way they know how. The broker is then taking in that data and looking at it, understanding, where the best fit in the market is going to be. And so, they're sending that data over as they've collected it. Underwriters are then struggling to communicate to the broker that they need the data in the way that their systems will recognize and the way that they can understand the data. So the industry is embarking upon sort of an idea of what third-party data will simplify and reduce the friction and create more trust, not break trust. So again, the broker is bringing forth the data to the underwriter in the best way they know how and the best way they've collected it. They're embarking on their own data strategies and investing in their own third-party data strategies to cleanse and augment the data, to send it to the underwriters based on the number of questions throughout the years that they've gotten, sort of, understanding what does the market need? How do we put this in a structure, in a format that the underwriters, the insurance companies, are going to be able to readily use for their underwriting appetite, their risk assessment, and ultimately their terms and conditions and pricing and benchmarking those clients based on other insurers like them. Underwriting companies are also embarking on and investing in third-party data strategies. So what I always said to the underwriter is, yes, you have a relationship with the broker. Your obligation is to validate what the broker sends in, not just to accept it on face value. So as an underwriter, as I mentioned earlier, it's table stakes for you to understand the lines of business, the coverage forms, and pricing strategies. What brings you to the next level as an underwriter is really understanding how to spot the variances in the data that don't make a lot of sense. And where do you get the data that is, or go to validate that data? So one of the things through artificial intelligence and machine learning is to actually learn where the underwriters are going time after time, pointing them to that source to cleanse, validate, augment the data, and then the underwriter can make their decisions based on that and inform the broker, I've utilized this data source and come up with my decision based on this, as opposed to what you've sent in. For one carrier, we found out when they used a third-party data source for augmenting and cleansing their property, their data quality went up by 65%. Which is immense. And you can imagine the amount of underwriting leakage that has been recovered as a result of having that better data, which then ultimately creates the cycle of better predictive analytics and more consistency in your pricing to those types of risk.
Absolutely. And that helps to prevent premium leakage and understand how many of your clients are not properly insured. And well, there's so many benefits. There's one thing or part of the solution to reduce this friction between underwriters and brokers, I think, is asking less questions in the process, right? And I think underwriters aspire to ask less questions, but at the same time get more relevant information. So I guess my question is, how can we make this possible? What are the technologies out there that we can use to achieve this?
I think first and foremost, one of the things that we have to understand is the information needs to be pushed to the underwriter. The underwriter doesn't have time to go and grab the information. The broker is not always available to answer a laundry list of questions. So, thinking about what really matters, and it comes down to what data, again, as I said earlier, what data do we really need? Do we need the immense amount of data that we've collected throughout the years? Should we continue doing this just because we've always done it? Or can we streamline the data that we're collecting, understanding those critical data elements that are needed to do an appetite match, to do a risk assessment, to do a proper match of the risk and controls to terms and conditions, and then ultimately come up with a price that is economically viable for the insured to transfer that risk to the insurance carrier. So again, it comes down to understanding what data is absolutely needed and required. Where are the best sources for that data? Is it from the insured? Is it from the broker? Is it from publicly available data? Is it from third-party data sources that we can purchase? There are a lot of insurance adjacent organizations that are figuring out ways to monetize their data and submit that into data packs to insurance carriers, whether they're TPAs who have looked at the various claim data, whether they're looking at various, risk and loss prevention data. Again, multiple sources, data scraping from the internet, but ultimately looking at that particular line of business, that industry segment, that geography, and knowing where the best quality and best complete data is found, and then how do I bring those data points together, push that to the underwriter at the point of decisioning.
Yeah. So you've mentioned third-party data sources, third-party data providers. We've seen a lot of insurance companies are either already using them or starting to use them or are considering using new ones. And from your experience, what are the benefits that we can find in using third-party data providers or sources?
Yeah, again, as I think it goes back to having the artificial intelligence, the machine learning to identify what data is missing from this opportunity, this submission pack, right? And so if I can identify, first and foremost, is the data complete? Then I can go and I can look at the data quality. And so scoring the quality of the data, meaning that data that's come in and then matching it, bumping it up against that third-party data. It could be as simple as cleansing an address, right? And so understanding where the address is, if it can be, once you've cleansed that data and you've got a better address, you then can get better latitude and longitudinal coordinate matches for things like NatCat modeling. When you do that, when you get an actual, parcel match and not just a street level match, now you can identify the full risk associated with that parcel based on the front of the plot and the back of the plot. And so again, it's about understanding what data sources by line of business, by geography, by industry segment are available. Likewise, having payroll information, being able to link into some of the payroll services organizations and push that information forward. Now I take out some of the friction in collecting the class codes and the payroll data associated with those class codes by state, right? So now I get a better picture more instantaneously based on real-time information coming from a third-party data source. Likewise, in some of the hospitality industries, I can do the data scraping and find out information about the condition of the property, the management controls, and the management behaviors.
And there's so many interesting data attributes we can find. I was just thinking when you mentioned the address issue, it is indeed an issue, especially we're finding that in the UK market, and I guess this applies to every market. Sometimes the address the insurance company has about the business is where the business owner lives, but not where the shop or the business is actually located. And we were talking to an insurance company recently saying, I'm receiving a lot of claims from my business lines for business products, and I'm paying those. And then when we send someone to repair them, we're finding out that that's actually a residential house, right? Because the business owner knows that the insurance policy is covering their own home, and sometimes it's just as simple as the fact that the business owner registered their own address when they created the company. They just didn't have any shop yet. And then they opened up the shop and they simply forgot to tell the insurance company that they have a new address. The broker didn't ask. And then there's a gap, there's a missing conversation or contact point here that I think third-party data services, providers or sources can solve without bothering either the broker and the business owner.
Yeah, I think that's right. I mean, it's the other thing is the annual updates, right? And so when do we update the information? When do we collect data? And getting into a sequence and a cycle of collecting the data when the data changes, updating the data, updating the values, aging the buildings, those sorts of things are critical. And often there is a omission, right? There's an act of omission, not an act of commission, to not report that information, which can lead to underinsured, which then leads to some penalties, which leads to often, having a bad day become a worse day when you have a claim. So keeping up with that information, understanding you could have an industrial park or a campus and have an address that is for the entirety of that business, but it's not appropriate for some of the buildings on that campus. And so again, having some of this information available, having the sort of mapping and other sorts of third-party data that you can do an aerial view of a property, understand the sort of the exposures around the property, all of that makes for a better underwriting outcome and ultimately a better outcome from the insured because they are more properly insured. The insurance to value is better. You have a better track on the inflation, and therefore, again, you reduce underwriting premium leakage and you have better claim outcomes.
Yeah, it's a win-win really for the business owner and the insurance company. When we talk to insurance companies, they say, look, we have to pay the claim because in the end, we don't want to lose a client, even if we think they're not covered. But sometimes it's hard to say we're paying less than what you were expecting. Sometimes it's hard to manage the reputational cost that it has. At the same time, the business owner thinks, well, I'm paying for insurance. When I have a problem, they should pay back, right? They don't understand if some part of the information was missing or if it was their responsibility to update the policy information every single time something changed. You can imagine in a small or medium enterprise how many changes in the risk of that company happen during the year, right? Number of employees, the sales level, what they are selling, if they're selling online, if they're changing the products, if they open up a new shop. Those things are constantly happening. And of course, if we don't have a way to monitor automatically how the risk is evolving, keeping track of that just by asking once a year is a very hard task for everyone, I think.
Yeah, I think it's, we've gotten into the cycle we've gotten into the habit of a 12-month underwriting cycle as opposed to a cycle where the underwriting is done continuously. And again, when you've integrated with other sources, whether it be sales, data where the insured is providing quarterly financials to their business partners, whether it's banking or insurance, you can get some information and do some correlation analytics. If you're sort of connected to, again, their payroll providers. And then ultimately, you can also look at scraping information and have alerts. And this is more for, construction, is the building permits, right? So what building permits are being issued, and what was the, why were they issued? So what is the nature of the project? Where is the building, sort of the building permit? What are the terms and conditions with that building permit? Those sorts of things can also help. And so again, it's understanding how and where, so where, when and how do I tap into that information so that I can get into a cycle of understanding, being alerted when that risk, the exposures change. When I was an underwriter, I was working with some construction and some energy clients. And one of the things that I did was set up alerts. And so anytime something would occur with that insured, whether they hit a news cycle or the building permits or other sort of things that might happen with OSHA violations, that sort of thing. So I would get an alert, and when I would get that alert, then I could interact with the broker to say, hey, I have this information. Could we possibly, set up a meeting with the insured to discuss what might be happening? Again, with the larger insureds, that information is sometimes more readily available. For some of the smaller insureds, the small, medium, hospitality type risk, now that we have all of the social media, we have the web scraping, you can get an alert when there is a major situation that might occur, or a notoriously bad review, or pictures that might show up, right? And have those alerts brought to the underwriter, so then they can get back to the broker or the agent, who then can set up a conversation with the insured. At the end of the day, we want to pay all of the claims that deserve to be paid. There are some claims that, quite frankly, just don't deserve to be paid. We saw a lot of this during the pandemic with business interruption. And at the end of the day, that created, again, more unnecessary friction and a lack of trust within the buyer, the broker, and the underwriting community. And so the idea of all of this sort of, transformation and modernizing the insurance industry is to increase the speed of trust, reduce the amount of friction, and increase the awareness of, again, what coverage exists, why does it exist, and what are the triggers for that coverage, as well as what are the exclusions for that coverage to be put into effect at the time of a loss.
Yeah, and now that you're mentioning exclusions, maybe because you've been an underwriter, you can help me with this. When we were working with an insurance company based in the US, we were trying to automate the data collection process during the underwriting. And one thing they said is, we're very interested in identifying when restaurants or bars have karaoke at night. And apparently karaoke seems to be a game changer in terms of risk. Like, it's a completely different risk if there is karaoke. We never asked why, if we ever found out. Do you have any idea why karaoke can be so risky compared to not singing?
I'll just say liquid courage. And so one of the things that you will see is there are, the alcohol sales, right? And so when looking at a restaurant that is maybe a sports bar, but then after sort of a certain time becomes more of a bar, they may have some dancing, they may have some karaoke, they may have some other sort of activities that would create more hazard than just a sports bar or just a restaurant that happens to serve alcohol. For instance, there is a restaurant that is franchised, well-known sort of sports bar, kind of Tex-Mex pub, and one of their locations that was independently owned did have after hours, it was late night, so late night being 10 p.m. or after, music, a DJ, dancing, trivia, and then on some nights, I think it was Wednesday or Thursday, would have karaoke. That risk materially changed as a result of those things. Similarly, there are some quick serve restaurants that start to serve brunch on Sundays. one of the things you want to ask about that is, are you serving alcohol now? Is it beer and wine only, or is it alcohol? Because boozy brunches have become quite the fashionable thing, at least here in the US. And so again, it materially changes. You want to be able, to understand that it changes the cost of your general liability insurance, right? So if you're looking at the food sales, you're looking at the alcohol sales, looking at the patterns for when those increases might occur, you can better understand the risk. It doesn't mean you have to exclude those operations. It just means as an underwriter, you're thoughtful, you understand them, you've appropriately priced, and you may have the opportunity to say, you might want to get some host liquor liability. There may be some other coverages that are missing from your standard coverages because we didn't understand that's what you did.
Correct. So the more alcohol they consume in that business, the more likely they are to have a claim, I assume.
The higher the probability.
Yeah, okay. Yeah, it makes sense to me now. Thanks. So just to wrap up, we have a lot of underwriters that watch this webinar, and we love you guys. Thanks for watching us, as always. If we can summarize or let's say, if you had to give 3 top tips to an insurer that plans to digitize the underwriting process, what are the 3 things you would recommend to them?
Yeah, I would say first and foremost, look across the standard activities and understand where the human has to be in the loop and where the human doesn't have to be in the loop. Find ways to create the right algorithms, the right business rules to take away those things that are more standardized, right? And then look at the data and understand how the data, how your data is structured, where the data is being, where the data needs to be mapped to for the purposes of underwriting, for the purposes of aggregation management, for the purposes of claims, and then come up with the right data strategy. Bring your teammates, right, your employees into the conversation so that they are part of the decisions for determining the algorithms, right, how the business rules are created, making sure also that you focus on the ethics of the AI and the ML, right? Because one of the things that is going to be critical as we adopt, artificial intelligence, whether generative AI or sort of the standard machine learning that we've been doing for years, is understanding the bias, right? The bias that we may have create around data collection, the bias we may create, and how we are presenting that data, rendering the data for the decision making. So again, that data strategy, understanding the sort of the amount of data, where the data is coming from, the data strategy, the data governance, including creating a environment to recognize and extract bias from that data collection, that data rendering, and then ultimately helping the underwriters to get comfortable, the claims adjusters, the pricing actuaries to get comfortable with their new activities and the new competencies, right? So as we move through this cycle, the talent, again, as I said earlier, is going to have to change. So the underwriter is training the machine is training the underwriter. It becomes a human and machine partnership so that, again, you get the best data with the best insights. You understand what data I have to intake, what data I need to digitize, how I map that data, what data is best received from a third party. And then ultimately that sort of cognitive risk assessment, that is that risk profiling to alert the underwriter to risk like these, the sort of the exceptions, the anomaly, will then ultimately provide underwriters with the right time to be curious, the ability to have confidence in their decisions that they're making, stand behind their decisions in the marketplace, ultimately delivering more consistent decisions and more consistent financial outcomes over all market cycles.
Great. I really like the idea that the machine trains the underwriter and the underwriter trains the machine. I think that's like the perfect vision we can keep to conclude this webinar. Well, Taffy, it's been a pleasure. Thank you so much for joining us today. I really enjoyed this conversation. I think we'll give a lot of highlights to the underwriters. Thank you. Thank you for joining.
Thank you for the opportunity. I really appreciate it.
Of course, of course. And to all of you guys, I hope you enjoy this webinar. You can leave comments on the chat, or you can leave comments below on the video, and we'll see you in the next one, hopefully in a month. Thank you.